And to the question profitability, if you look at our numbers for the last 3.5 years, FY 23, 24, 25, and the first half of this year, the business has roughly added 3-4% more EBITDAs each year. EBITDAs or net profit, or if you look at the full flow there. So we've roughly added 300 to 400 basis points. Even this year, first half was the last year first half. You will see a 3 to 4% swing on EBITDAs and net profits as well. So the business has been in that trend of saying on a continuous basis, keep adding 3-4% additional EBITDA. If you take where we are today, if you take the first half of this year, on a roughly 360 crores of revenues, we've done about 40 crores of EBITDAs and 55 crores of free cash. So it's between a 11% to a 15% EBITDA free cash, right? So even if you take all of last year, on a 598 crores of revenues, we did 76 crores of EBITDAs, right? So again, about 11-12% EBITDAs there. So we're already in the double-digit EBITDA mark. So it's not a case of, that now between EBITDA and net profit for us is the depreciation amortization on some of the M&As that we have done, right? So if you look at the core business as such, that is generating serious cash, right? On a 360 crore revenues, we have a 55 crore of cash in the first half of the year. And we will continue to acquire, right? So because we believe that the market is so underpenetrated, and our acquisitions, if you look at this data again, take the example of Riley and Partners, where we've given a case study on the acquisitions, and today that business generates a 42% contribution margin, right? We paid how much did we pay? We paid 0.5 times or 0.55 times revenue for it. It generates 42% contribution margin today. So you can do the math on how quickly the payback is, right? So these acquisitions are definitely EBITDA and cash accretive, right? So, and we've done 3 of them have kind of fully migrated and moved to this 30% plus or 40% type contribution margins. So for us, I think you can't paint everything with the same paintbrush, right? So in our case, I think it's interesting to understand the angle that cash and EBITDA does not translate to net profit because of this depreciation amortization of the M&As that we do today and we'll continue doing. So we'll continue to be a high EBITDA, high cash generative business, and using that cash to basically buy more. Right. So
I understand it, and absolutely there is no intention at my part to paint you in with the same brush. But you just said it that you are going to you will continue to acquire new companies, which also means that you will continue to have these high depreciation and amortization charges every year. So when do we as retail investors get to see net profits? I mean, good fat net profits, double-digit margins.
Anil, so I think where the business is it's a $17 billion addressable market on loyalty. We are at less than 1,000 crores in revenues today, right? So there is a massive headroom out there. And like I mentioned, loyalty is extremely, like Anand mentioned, it's a very sticky business. Our annual churn is 5 to 7%, right? So I do think it's in the best interest of the business to continue to grow and continue to keep adding, cash from operating margins for the next few years. And we'll continue to buy till we see good opportunities, right? Our discipline is basically to say that, look, these have to be high ROCE buys. We should have a path to getting them to like 35% plus contribution margins, in which case it pays off in like 3-4 years, right? The cash you've spent on the buy pays off in like 3-4 years. So we continue to buy, and to be honest, our model is to build one of the best product companies in our space globally, and I do think we'd want to focus on that. So you will see us deliver good EBITDA. You will see us grow net margins every year, like we have done in the last few years. But to the question of Will we stop doing acquisitions? I think I don't think that's in the best interest of the business.
Hmm. Fair enough. Yeah, I'm definitely not suggesting anything like that. But my concern is largely around profitability on net basis. Uh, also, beyond this inorganic growth, what are your growth plans to grow organically? Because it's such a wide industry. Uh,
Correct.
so it must be somewhere on your map as well.
Yep. Only less than half our growth comes from inorganic, Anil. So more than half the tripling has come from actually organic. Anand, do you want to touch on those organic levers?
So Anil, as I was sharing initially, it's about 40% of the expansion came in organically. About 60% has come organically. So within organic, we have again two focus areas. One is winning new logos in the market, and within that, you also try and win a lot more larger customers. So we try and win a Fortune 500 customer every quarter. Today we have about 19 of Fortune 500 customers on board. When we had actually filed the RHP, that time this number was 16. That was just 2 quarters back. So a lot of focus on winning larger customers. So dedicated sales and marketing team which does this, and we work with or if you look at some of the independent analysts in the space, like people like Forrester and Gartner, if you look at their reports, Capillary would feature in the top two globally. So that has helped us get invited to most of these large RFPs that come into the market. And the other thing that we have seen is that our existing customers grow by about 15 to 20% every year. That's a major lever of growth for us. Basically, in the SaaS world, this is called as NRR, net retention revenue. So your existing customers, how much they are growing on a year-on-year basis with you. And this growth is a lot more predictable as well as profitable for us. And this kind of shows that the customers are wanting to do more with you. They're going live with you in more countries, taking more products, expanding your product portfolio, as well as you kind of entrenching deeper into their ecosystems. So these two largely on the organic side of business, both winning new logos as well as growing consistently with your existing customers. So this brings in majority of the growth for us.
Okay. You also mentioned that this is a high stickiness business model, uh, which should be true for your competitors as well, who are already providing their services. So, what exactly causes a company to leave one company and move to a capillary or its competitors for that matter?
Yeah. So typically, Anil, what you see is the industry in the West is lot more with agencies, which is a very people heavy method of delivering loyalty as an outcome. And you would see that it takes a long time for people to design the programs, configure or execute any campaigns. To give you an example, running one campaign in an agency world can take as much as like 1 to 1. It's a 1 to 1.5 month exercise because you give a brief for the campaign. Then somebody would design it. You would create those agencies would create a team of 4 or 5 people, one business analyst, one architect, one developer, one QA. Then they would deliver the whole thing, and then there would be somebody who, after the campaign is executed, would pull the data out, generate reports, and then report. In a software world, in Capillary software, the customer gets the power in their own hands. So they don't have to rely on somebody else. They don't even have to reach out to us. There is somebody who is trained at their end, who just by using the software would be able to design and execute the whole campaign in just a couple of hours. So there's a massive speed, and that's what businesses need today.
So I
So
get it. I get this point. Essentially, you're talking about the migration of this business from agency to SaaS model. But my question was actually more about your competitors, your direct competitors, not agencies, but the likes of, let's say, Salesforce. I think you mentioned Salesforce somewhere, right? So that is also a SaaS model or a software, basically software model, right? It's
Sure.
not an agency, definitely not an agency. Yeah.
Correct. So you're very correct here. Now, the method that most other tech players have taken is that they've taken or they've tried to solve the problem for loyalty as a more horizontal approach. What I mean by horizontal approach is that you have a single layer of platform or your technology, which is used across the board, and then depending on requirements of a particular industry type, they would do the customization. Now, think of loyalty for a conglomerate like Tata. The use cases are very different from that of an airline. So in case of Tata, the use cases are more that can I get a big basket customer to shop into a Titan, or can I get a
Right.
Taj customer to get into a Tanishq, right? Which is very different from that of an airline, or very different from that of a healthcare. The approach that Capillary has taken is that it has picked each of these verticals, industry verticals, and built deep products for them. So most of their requirements are out of the box available on the platform. So most of the requirements of today, as well as requirements that they might have over the next few years, are available out of the box, and that helps us win against the other tech players also in the market.
And you believe creating or replicating these kind of capabilities would be somewhat challenging for other players like Salesforce because they have got so many other things to do also. That's what I understand from it.
So Salesforce has like 40 other solutions. This is one of those 40.
Mm.
But it's more the architectural approach that different players have taken. Capri has
I
taken a
think,
more
yeah,
practical.
correct. I think Salesforce looks at it itself as a platform, right? We have a
Yeah.
platform. You get your system integrator, do whatever you want to do. We are a universe of APIs, marry them together, build whatever you want, right? Our approach has been saying we want to be the best at loyalty. So we picked one space, build deep for it. So I think that's the difference in approaches. Also, if you look at the space, Anil, to the point that Anant was making, most of it is even today owned by agencies or by large in-house teams.
Hmm. Okay.
Yeah, I think we lost Anish.
Yeah.
Cannibalize each other. I don't think we need to cannibalize Salesforce or Salesforce needs to cannibalize us. There's enough business in just moving people from in-house or agencies to us.
Got it. Fair enough. All right. I think we are crossing the time limits again. So quickly now, we get to the fag end of this discussion. Uh, I was just running some numbers, and it looks like your post-listing market cap is going to be around 4,500, or rather 600 crore rupees. If I compare it with your previous year's revenues, the multiple turns out to be somewhere between 9 and 10, uh, which is quite high. So we are talking about price to sales ratio. Uh, I'm not at all talking about PE ratio because it's running into four digits. Yeah, that's very high. So, but even on price to sales ratio basis, this appears to be quite high, and I wouldn't really say that the business doesn't deserve it, but I would just say that, okay, it's running slightly ahead of the fundamentals right now. So maybe you can
Yeah.
shed some light on this.
Should I take that down?
Yeah, good.
Yeah. So Anil, we first of all we did 598 crores last year at the 4600 type number. You're at a 7.5 times to last year number. If you take the first half, we did 360 crores. If you do again 4600 by 720, current in that sense, you're at about 6.5 times, right? So Now, like you initially pointed out, Anil, we'll be amongst the earliest SaaS companies to list in India, right? So, but SaaS is not there are hundreds of global peers. Whether you look at the US, there's hundreds of public listed SaaS companies. And even if you look at our what's the section called? There's a section around pricing the IPO in the RHP. We've actually referred to a bunch of these public SaaS companies, like a Salesforce, Adobe, etc. Right? Adobe, Braze, HubSpot, Viva, and the likes. Now, typically, if you look at these companies, Anil, they trade between 6 to 10 times revenue. Right? That's the usual numbers there. Now, if you look at our churn numbers, 5 to 7%, our CAC break-evens, 14 to 16 months, our net retention rates, which are upwards of 115, we would probably trade at slightly the higher end of that band of 6 to 10. Even at the upper band of the number that we put in the, we'd be going out at 6.5 times revenue, right? For a business that continues to grow at 25% plus in revenues, high retention, double-digit EBITDA margins, right? So I think that's a fair benchmark to look at, the EV by sales thing. Another thing I would encourage you to do is look at if you did a EV by cash generated, right? Which is we at least as entrepreneurs look at the business as how much cash is the business generating, right? Unlike and cash is king eventually, right? The amount of cash the business is able to generate is really gives you purchasing, the power of your own pricing power, your ability to collect, all of that comes in, right? When you talk about cash, right? So again, if you look at like a whatever EV by cash, you're probably in the 40s, a multiple of 40s, right? So I think some of these are and more importantly, we spent the last 2.5 months actually meeting over 80 institutional investors. Our anchor book is also out. It has 2 of the top 3 and 6 of the top 8 mutual funds in the country. Even in terms of globals, you have an Amundi, you have a HSBC, you have pretty good global funds as well. And none of us are selling in the IPO. It's a bunch of early investors. That too, most of them are selling partially. Other than one investor who's selling full, everyone else is selling partially, right? The primary is a small one, so we've let the market kind of these conversations with these investors decide what the fair value is, quote unquote, and hopefully, it means that we're able to go ahead and deliver good returns to all the investors who are coming in the IPO.
Okay. All right. I was just, while you were speaking, I was able to dig out some numbers. The price to sales ratio for Salesforce, which is several times bigger than Capillary, is around 5.8 to 6.3. So, and I totally understand that you are a specialized player, but then that also limits the potential for Capillary. So I still think it is on the higher side, but I'm not really sure whether there is a point in taking this debate ahead. Eventually, the markets will do their job. But I wish you all the best for the success of the IPO. Your business model is wonderful, very very interesting business model, and I hope you grow by leaps and bounds in the years to come. And hope to see you around. Thanks a lot for your time.
Thanks, Anil.
Thanks, Anil. Appreciate it. Thank you.